Welcome, financial professionals. I am Jessica Bowden, Regional Vice President, E4 Insurance Services, welcoming you to The Brew, building relationships every week. Thanks for tuning in. For those of you joining The Brew for the first time, welcome. We would like to start The Brew cast by celebrating today's national days. Today's national day is Fruit Cocktail Day, Top Gun Day, and National Tulip Day. May's lineup will focus on disability, as it is Disability Income Awareness Month. We will highlight the importance of proper disability planning and discuss tips to navigate disability underwriting and more. We will have a few special guests joining us, so stay tuned. Today, Sean McNiff, Vice President of Business Development and Marketing for Exceptional Risk Advisors, and I are excited to discuss Exceptional Risk High Limit Program in both life and disability. Lloyds is not just for athletes and entertainers. Their GSI program covers upwards of $50,000 per month for executives, tech moguls, attorneys, physicians, and business owners. Sean was the second employee hired by the firm when they opened their doors in 2007. During his time at ERA, Sean has facilitated the placement of over 1,000 policies, helping clients protect over $1 billion in unique risk exposures. He is a terrific resource and someone our advisors can work with directly when an opportunity presents itself. Sean, thanks for joining us today.
My pleasure, Jessica. Thanks so much for having us. And thank you all for joining me while I tell you a little bit more about the Lloyds market and how advisors leverage Lloyds of London for their most exceptional clients. So my name is Sean McNiff. I've known Jessica for a long time. I've been working with E4 for a couple of years now. And, we really do cater to those exceptional individuals within your book of business. So I'll tell you a little bit about Lloyds of London. I'll share a little bit about how we work as a cover holder for Lloyds. And then we'll walk through a couple of different products that we offer and some case studies on how those products are applied to your high net worth or soon to be high net worth clients. So if that's something you're into, let's get into it. I always start with a picture of the Lloyds building. This is a picture of Lloyds. It sits in the center of London. It's a big part of the city. And all the pictures that you see of Lloyds look really beautiful. If you go there in person, it's quite hideous, if I'm being honest. I call it the espresso maker. The reason it looks like this is because what Lloyds did was when they built their new building, they took all of the internal components of a building and pushed it to the outside. And the reason that's important is because when you look inside the Lloyds market, it's all usable space. So this is the internal view of Lloyds. Most people think Lloyds of London is a carrier, but the reality is Lloyds is truly a marketplace. It's almost like the stock exchange. And at all those desks, which they call boxes in London, sit the syndicate partners. And syndicates are really just a creative name for large companies. There used to be private wealth individuals that would come in and participate in risk. But for the most part today, there are about 90 syndicates that will trade risk, that will take on risk. Exceptional risk advisors, we're cover holders in the Lloyds personal accident division. Here in the US, we call that the life and health division. Of the 90 or so syndicates that operate at Lloyds, roughly 40 of them participate in personal accident programs. And that's where they're insuring people versus property and plant and liability. So as a cover holder for Lloyds, we have a really unique position inside the marketplace here in the US. We function as an extension of the Lloyds market. And what that means to you as an advisor is that we're the folks that really function more like an insurance carrier. So we go to London a couple of times a year. We set up different binding authorities that allow us to transact business in different segments of our marketplace. So high earning physicians, entertainers, athletes, they're all siloed into different binding authorities. So the syndicates that want to participate in those risks can participate accordingly. As a cover holder, we have the ability to set our own pricing. We do our own underwriting. So when you're sending in financials, medicals, applications, it's our team that's looking at all that and making the decisions on how to place that risk. We also have the ability to manuscript policy language, which is unique in the marketplace and can be used when you're working with unique contracts. So, buy-sell agreements that have specialty language for triggering a disability buyout. Unique entertainment contracts that need to be tailored the right way to fulfill a third party's obligation. Even divorce decrees or prenuptial agreements, we look at all that language and we can tailor our policies to fulfill the requirements of an agreement, which is really nice. And it makes our advisors look like rock stars because we don't have to go back to the client's attorney and say, no, you've got to rewrite this language to fit the insurance contract. We can actually lift that language out and use it to design our policy. As a cover holder, we function as the surplus lines broker inside of a transaction, and we help our advisors with all the small nuances that you see in placing these different policies between different states. Each one has different forms. We make all that stuff really easy for you. So if you ever have an opportunity in the Lloyd's market, we open ourselves up as a resource really to sit like an expert, by your side and help you navigate, whatever it is that you're working on. So today we're going to go through the opportunity that the opportunities that you can use the Lloyd's of London market for. And we'll start with, probably, one of the biggest opportunities that most advisors don't recognize is insurable in the Lloyd's market. And that's key person disability insurance. So for you life insurance advisors that are listening in today, the key person disability market here in the US is relatively limited. It's really extremely limited if you're in California or New York or certain states that don't have products. But assuming you can get access to a key person disability program here in the US, the limitation and the benefit limits on those programs really cap out around $750,000 per person. So if you're in a key person placement environment, anything north of $1 million, you're really going to be, sort of at the top or maybe writing it from the ground up with Lloyd's because you're in a state that doesn't have the program. And in those situations, you'd go to Lloyd's first because there isn't a product that's suitable for your client. You'll see here, we have limits that exceed $100 million per person. Generally, we're trying to align the key person disability insurance with the key person life insurance you're placing here in the US. We design the policy the same way, meaning corporate beneficiary, corporate owner, corporate premium payer, with the insured being whoever the key executive is within that company. Most of these programs in the corporate environment are designed to pay a lump sum benefit, which I tend to refer to as a living death benefit, after a 12-month wait. So if you're looking at, sort of what's the average placement look like, it's a 5-year policy term, which is the longest policy available for any product in the Lloyd's market, with a 12-month waiting period that pays a lump sum benefit if the insured is permanently and totally disabled from their own occupation. We can write this coverage on an individual basis, which is how 99% of that business is written, or we can write it on a multi-life design if you've got 10 or more qualified buyers. And where we see that is mostly around partnership agreements that require a disability buyout for a group of highly compensated executives or attorneys. To look at a case, this is a relatively large case we wrote a few years ago. This was a 53-year-old that came out of a very large IPO, and upon exiting his previous company, a group of lenders came together and gave this individual a $75 million checkbook to go build out an instant messaging platform for options traders. The investors were all financial institutions. With the initial investment, they created a board, and the board required key person insurance to the tune of $50 million. So they said, here's the checkbook. You can use it at your disposal, but we want you to insure yourself from death and disability up to $50 million. We presented a number of different designs, and what they ultimately purchased at the end of the day was a $50 million key person disability policy that would pay a lump sum benefit after 18 months. You get a nice discount when you slide the waiting period on a key person policy from 12 months to 18 months. So if you're working on one of these deals, we'll typically show you a couple of different options on how to design it to give different premiums for the client's consideration. So here, $215,000 plus taxes and fees, that's an annual premium they would pay each year for 5 years. The reality on this case was after 3 years, they let this premium go. They felt like the company was built to a size that could support their investment and that the CEO was no longer truly key to the success of the business. As a sister product to key person insurance, buy-sell disability is a big part of Exceptional Risk Advisors offerings. In US markets, you can obtain around $2 million of buy-sell disability funding. And I say around $2 million because, again, it depends on what state you're going to the carriers for the product. And it also depends on the design you select. So if you want to follow the buy-sell agreement that you're insuring, most buy-sell agreements require a 12-month wait before they trigger a disability buyout of someone's equity. Most of those definitions, almost all the definitions I've seen for disability inside of a buy-sell agreement over my last 20 years have been permanent and total disability. So you don't want to have an agreement that requires a buyout on a temporary disability of a partner. So almost every design we put into the market for buy-sell purposes has been a lump sum only design that's payable after 12 months. So to look at how you would place a policy like this under a best practices approach, we'll look at a case. We had a paving business. They did paving, they did excavating, they did some river dredging, and it was a really high value business. It was around $15 million, and there were 3 equal equity partners. So we went in as the Lloyd's expert on this case. The advisor had secured 3 $5 million life insurance policies to fund the death buyout of their buy-sell agreement. And then we came in and looked at $5 million of buy-sell disability insurance. Under best practices, what you want to do is you want to go to the US markets and get as much lump sum coverage as you can before you layer in the Lloyd's coverage. So at the end of the day, we placed 3 $3 million buy-sell disability policies with Lloyd's on top of 3 $2 million buy-sell disability policies that were issued through Principal. So for our piece, it was around $25,000 of premium for those 3 $3 million buy-sell policies with Lloyd's. The total case ran around $76,000 in premium, which was the life, the traditional disability coverage, and the Lloyd's coverage. And when you reflect on that, for a $15 million business, it's really a drop in the bucket to fully fund their buy-sell agreement. So great case at the end of the day, and a successful placement for everybody who was involved. There were attorneys in the room, there were accountants in the room, and the insurance advisors looked great because they understood how to construct the disability piece of of their planning. So moving on to high limit disability income. High limit DI is probably what Lloyd's of London is known best for in the world. You think about Lloyd's and you think about people insuring their legs or their teeth or their taste buds, or if they're a pitcher, their arm, or if they're a surgeon, their hand. We get a lot of those calls. The reality is, yeah, of course, we're going to insure their arm and their hand, but we're also going to insure the whole body. So if you know somebody who's specialized in a way that a particular body part is a big part of their occupation, just make sure that the people who are asking you for that coverage understand they're just as bad off if they get in a car accident and have brain damage or break their spine or get cancer or something hits them that's just unforeseen. So you want to protect that whole body and maybe emphasize the policy to cover the hand or the arm. Or even for some entertainers, we apply facial disfigurement language. So if they've got contracts with, big cosmetics firms, their policy is as strong as we can make it. You'll see here monthly benefits of up to $250,000 per month. The reality is our binding authority can allow us to issue coverage beyond that. We just don't see it purchased in practice very often higher than $250,000 per month. $250,000 a month covers somebody who's earning $5 million annually at a 60% replacement. So it's quite a bit of insurance. The design on these policies are a little different than what you'll see a US domestic disability carrier offer. Most of the high limit disability designs we see purchased are what we call combination designs. So you have a monthly benefit that starts after typically 90 days. If you want some premium savings, you push that out to 180 or maybe even 365 days. And that monthly benefit will run for 60 months or 5 years. And then if that individual is permanently disabled after that 5 years of monthly benefit is exhausted, there's a lump sum benefit at the end of that period that's really designed to be the net present discounted value of that monthly benefit if it was paid to age 65 or 67. So everything we do is under own occupation definitions of disability. However, you should recognize the monthly benefits are paid under a temporary version of that versus the lump sum benefits that are paid under a permanent and total definition of your own occupation. So lump sum benefits exceed 25 million. That's certainly true. And we do have the ability to write guaranteed issue coverage, which we'll talk about in a few minutes, how we can deploy GSI offers with Lloyds. A couple of things I should note. If you're working with clients that have contractual obligations, if you're working inside of employers who are giving out employment contracts, we've got a number of companies that will provide employment contracts to individuals where the replacement ratios are above 60%. Maybe it's 65%, maybe it's 70%. In those situations, we follow the obligation of the agreement because the obligation falls on the employer. It's not as big of a moral hazard to us as it would be if somebody wanted to protect themselves at a 70% replacement. So employment contracts are a great place to look, especially if you're working with people that make north of $500,000 a year, because you're going to hit a cap on the domestic carriers where you just won't be able to get as much coverage. In US markets, you can typically get somewhere between $20,000 and $30,000 per month of individually owned disability insurance. Each one of those placements look a little bit different. So if you're working with anybody in that income bracket, I would say send it to your RVP at E4, and they'll look through, the domestic market to see how much coverage they can get. And then we're going to supplement that placement with a Lloyd's contract. So you'll actually be looking at, sort of a tiered placement. The domestic goes in first, you get as much as you can, and then we transition all of those underwriting requirements to exceptional risk advisors to look through and underwrite a supplemental Lloyd's policy sitting on top of that. Specialty surgeons and physicians are a big part of our market. You've got your financial executives, your hedge fund and private equity experts, and then your technology experts these days are going to the moon. So again, anybody that's making north of $500,000 a year, regardless of the occupation, if they haven't created a large net worth for themselves yet, I would argue they're in a critical risk period of their own occupation. That's really when you want to be looking at protecting their financial future.
Sean, if I can interrupt you real quick, I heard you say that you play some, base policies, U.S. policies with principals. How does that work for underwriting with exceptional risk? Would we have to go back through paramedical exams and new blood work, or how would you handle that whenever we are looking at some of these cases?
Yeah, it's a great question. So we're almost always coordinating that with the E4 RVPs so that we know, hey, if you're going to place a domestic policy, what are the underwriting requirements? And if our underwriting requirements are I guess, more thorough, we're asking for exams when the domestic carrier isn't. We're asking for an EKG, the domestic carrier isn't. We're going to try to get concessions with Lloyds, and we can almost always do this to follow the underlying program. And so as long as we're not looking at an extreme amount of insurance on top of a domestic placement, if you're placing $20,000 per month with a domestic carrier, and then you're going to go buy 25 million plus outside of that, you might struggle with that because it likely will cause a decline in US markets at that net worth. But the general, what I'm trying to say here is that we're going to almost always align with those domestic carriers and get concessions to move the domestic file over to exceptional risk and use that to underwrite the policy. We try to make it as easy as possible.
Yeah, underwriting disability gets a little tricky because it's both medical and financial. And so it's nice to know that you guys can utilize everything that we gather up front without having to go back to the client and asking for too much more. We just need to coordinate those efforts at the beginning of a case.
We can. And if you're working with anyone that has accelerated underwriting offers, we can do that as well. We have an accelerated program for executives and professionals only that will allow us to essentially speed underwrite Lloyd's placement using an application only, as long as the individual is under the age of 50 and the total amount of insurance we're looking at is under 7 million.
Thank you for that.
So to look at a case, this is a 48-year-old out of New York. This was a hedge fund manager making roughly, 2.6 million annually. And I say roughly because their earnings kind of go up and down. They stay high, but their average earnings were around 2.6. They maintained 35,000 a month in the domestic markets, which is higher than what I just said. I realize that. The way that they were able to do that was to accept an LTD offer at their employer and then buy as much private insurance outside of the employer to stack on top of their long-term disability coverage. That got them to $35,000 per month. We designed a couple of different policies to bring them all the way up to a 60% replacement. They didn't buy the full 60%, but they did buy a policy that paid $75,000 a month on top of the $35,000 a month in the US for a period of 120 months, which is the other design for disability income protection. So you have that combination design that I referenced a few minutes earlier, and then the second design to that would be a 10-year benefit period, which we almost always use in a GSI environment. And I think it works really well for individuals that might have the ability to collect on a residual rider, where if they're earning a portion of their income still working, you want to extend that benefit as long as possible before you tailor a policy to provide a permanent and total disability benefit. So premium on this, $32,000 a year plus taxes and fees. For somebody that makes $2.6 million, I think it's an absolute no-brainer, and it's a really nice placement for the advisor involved. So then we kind of move into the fun stuff. I think I have one of the best jobs in insurance because we get to participate in insuring athletes and entertainers. I'll be the first guy to tell you I'm not a cool guy when it comes to entertainment or it comes to athlete insurance. I know the contracts inside and out, but I've got a few young kids at home. I feel like I've lost the connection with all the actual players' names, and we've got a whole team that does that. That's still very cool, so we can make you look good. But the reality is there's no coverage in domestic markets for these occupation classes. So when it comes to insuring athletes or entertainers, you just can't get coverage here in the US for that occupation. And the reason is their incomes are relatively volatile in the entertainment profession. So you'll see somebody become an A-lister, they go into kind of an early sunset of their career, they come back, they're making more money than they did the first time, and that up and down in income really pulls the domestic markets away from having an appetite to insure those individuals. When it comes to athletes, the risk is just so much higher, they don't want to participate. So, you'll see a few things here. PTD protection stands for permanent total disability insurance for athletes. We run a lot of athlete coverage through our business on the player side, meaning we're typically working with advisors that are working with athletes to protect their own incomes versus working with teams who are looking to protect guaranteed contracts in the major leagues. For example, Major League Baseball and the NBA. So each sport is a little bit different. We look at each sport in its own regard. For example, football, the NFL is a great place to buy PTD protection because their contracts are non-guaranteed. A football player will get a signing bonus guarantee and then year one compensation guaranteed. And then if they can't get on the field in years 2, 3, or 4, that income's at risk. They can essentially be cut from the team and their contract's null and void. The other risk we see is when any of these athletes are coming towards either our arbitration period in baseball or a free agency period in their career, they've got a critical risk exposure to signing that next deal. If they're disabled before they sign their next big deal, their future projected income is all at risk. So if we're working for an athlete where we're looking at a current contract, we're looking at contract values inside of their current agreement. As they get towards free agency, we're using comparables in their league to project their future income and looking at protecting that value at about 50%. On the entertainment side, the coverage looks just like it does for an executive or a professional. We run a 5-year benefit period, and then there's a lump sum benefit that pays after that if they're permanently disabled from being an entertainer. So looking at an actress, now this is an A-lister everybody would know. She earned around $5 million annually. The truth is she's probably earning close to 10 now. Again, no US carriers are going to participate on this. So the policy that we deployed for her was a policy that would start paying $250,000 a month for a 60-month benefit period. And then that policy was followed by a $10 million lump sum if she could no longer perform her own occupation duties. That total policy aggregate is $25 million when you combine all those benefits. And if you think about that, that should be an after-tax benefit protecting roughly $50 million of future earnings. We see this a lot in entertainment, especially for those who are younger in their career, in their 20s, in their 30s, in their 40s, where they've got a huge amount of future projected income that's non-guaranteed. So providing a policy for someone like this, I think you have to shift your mindset, even for high income executives and professionals. When you're working with incomes that are this high, and you think through what $2 million of annual income is going to be worth to a 40-year-old that wants to work for 20 years, it's a $40 million future asset. And I think that you shift your mindset from protecting their lifestyle to protecting their future non-guaranteed projected estates. It becomes an estate planning conversation far more than it does an income protection conversation. And the policies that we can put together, I think, really make advisors stand out with CPAs, attorneys who are doing estate planning. It's a different door to go have conversations with. And right now we're in Disability Insurance Awareness Month. I think it's a great time to go and talk to advisors, and especially your centers of influence, about the power of Lloyd's and how it can help your advisors really protect their best clients. So before we change, premium here, $57,000 a year plus taxes and fees. Again, reflecting against a $25 million program, it's really a small cost to protect that. Okay, so to look at a case in the athlete market, premiums are much higher. They go up quite a bit, especially because the risk associated with an athlete, their ability to use their body to perform at the highest levels in the world, there's a lot of risk associated with that. So here we had a MLB outfielder who was also a designated hitter, young, healthy, superstar in the MLB, was approaching free agency like I had discussed, and was projected to sign a 5-year, $105 million contract. This case is a few years old. These numbers have gone up pretty substantially in the last couple of years. In the athlete market, you'll see a premium here of $250,000. They're typically buying this one time, maybe 2 times in the MLB when they're going through their contracts, when they're going through their career span. So buying this coverage before that free agency period, again, it's really critical. And while the premiums are really high, they don't have to do this every single year. They just have to do it when they're trying to lock in their next guaranteed contract. So, they could have insured more than this in this case. They probably could have looked at a $50 million policy, but you got to judge what the premium appetite is for your player that you're insuring, especially if you're working with a rookie. Their contracts just aren't that big when they're in their rookie years. So you want to tailor the policy to get as much coverage as you can, with regard to their premium appetite. So, here we had a $25 million permanent disability policy that would pay, again, after a 12-month waiting period if they could never return to their sport as a professional MLB player. I should take a moment here and pause and just talk for a few moments about NIL and some of the other riders we can attach to these programs. Inside of the athlete market, there's now a rider that's called critical injury. Everyone's referring to it as CI. And what it allows a player to do is hedge against an injury that may devalue their future projected income. So, an athlete like this could buy a critical injury rider where a schedule quite literally gets attached that details the injuries that can occur. And if they hit one of those injuries, if one of those injuries occurs in that schedule, there's an automatic black and white payout up to $500,000 to really cushion them on the way to their next free agency contract. What that allows them to do is get the best rehab, cushion the blow from the loss of earnings that may occur because of that injury, and tailor the policy to provide them a direct inception of cash, really to use to rehab themselves as best they possibly can. With respect to NIL, name, image, likeness deals are really big right now. We probably get a couple calls a week with athletes who are college players signing NIL agreements. If you're in that situation, I would say just contact your RVP. All those deals are really different. They tend to roll up into a collective that a school owns, and all the deals are structured differently. So we need to dig into each one of those contracts. And most of the time, we're looking at a guaranteed contract, meaning they're going to get that regardless of whether or not they're disabled as an athlete. And we're shifting the conversation from protecting the NIL agreement to protecting their future projected income, where we can provide a much better policy, potentially using some of that NIL income to pay for the premiums. So as we sort of move to the end of the show, I want to take a few minutes to talk about guaranteed issue coverage with Lloyd's of London. We do a terrific job writing guaranteed issue coverage. What you need to know is that we serve as a third layer inside of a comprehensive GSI placement. And when I say that, typically group LTD coverage serves as the foundation for these plans. Then you'll go and you'll place a guaranteed issue offer on top of that group LTD plan to get those offers as high as you can with guaranteed issue coverage for the group that you're insuring. If there are individuals that then extend beyond what you can secure between the group LTD and the guaranteed issue coverage in the domestic offer in the domestic market, that's when you go and extend the opportunity into the Lloyd's market. So policy terms here, you'll see to age 67, guaranteed for 3 or 5 years. Truly, the policy terms, like I had mentioned, are 5-year policy terms. If you have an older population, we say they're to age 67, where that 5 years will bring someone to age 67. Monthly benefits generally are designed to pay 120 months, or again, if that 120 months brings them to age 65 or to age 67, we'll extend the policy and design it to pay as a cutoff at those age limits. We typically follow the guaranteed issue offer that's right below our offer in the domestic market. So if it runs to age 65, we'll cap ours at 65. If it runs to 67, we would cap it at 67. Maximum income replacements typically set at 60%. And to get these programs in place, you generally need to have the clients answer 2 questions, being, have you been actively at work for the last 180 days? Have you not missed a day of work in the last 180 days? If you can answer those 2 questions, coverage is issued. We've got all the same sort of ancillary benefits on our policy, like COLA and residual. We also have a limited mental nervous and substance abuse rider that we can attach to the policy. And then, are they portable? Yes, for the balance of the contract period. When you design these plans, they're designed for 5 years. So if somebody does port the policy, just understand they port it for the remainder of the 5-year term that they own. And then if they have moved to a place that has a Lloyd's guaranteed issue offer, they can begin participating at their new company, or they'll have to go into full underwriting if they've moved to a place where they just don't have a guaranteed offer. So there's a couple of different program types. I'll talk about the main 2. The main 2 are mandatory plans and voluntary plans. For us to offer a mandatory plan where everyone on your census is mandatorily being enrolled, we can start with 3 lives, which is pretty powerful when you're working with smaller businesses, because oftentimes you'll have a C-suite that's earning a lot more than the rank and file, and you just can't get enough coverage here in the US. So if you've got 3 people that extend beyond those offers in the US markets, we can begin offering GSI into that group at 3 lives. You'll see the discounts run between 5 and 35%. That's a function of how many people are in the plan. And you'll see guaranteed issue offers between $10,000 per month and $100,000 a month. Typically, we're capping those around $50,000 per month, which is a very generous offer. To get to that 100,000 mark, you're going to have over 100 people involved. So really big plan, but the Lloyd's market will support those offers for very large groups. And again, participation requirements for mandatory plans, obviously 100% of the people on the census. So if you go down to the bottom right, voluntary plans are, probably the largest premium driver of any program type, because you need at least 30 eligible lives to offer a voluntary plan to a group. And an eligible person for a Lloyd's program is going to be somebody that makes enough income to qualify for a Lloyd's market offer and is participating in the group LTD and the IDI layer in the US market. If you haven't installed IDI yet, anybody who is eligible for the Lloyd's plan would be defaulted into that eligible group because they haven't elected to either purchase that guaranteed offer in the domestic market yet, or it hasn't been offered. So again, discounts are the same, guaranteed issue offers, $10,000 to $50,000 a month. Again, we could probably push that a little higher for the right groups, The right groups being national law firms, national accounting practices, very large engineering firms, anywhere where you have a large group of high income earners, we can get the Lloyd's market to support a little bit more benefit than that. Target participation requirements, we're always targeting at least 30% participation. The reality is the mandatory requirements come down quite a bit less than that, depending on the average age and the amount of benefit being offered. So these plans are sophisticated placements. We've got a whole GSI team that will help you run those programs and coordinate those plans with the domestic markets. And when I say run those programs, we've got literal spreadsheets of what needs to be done over, generally a 6 to 8 week period for enrollment. And that's communicating with advisors, communicating with the actual not carriers, but employers offering those plans, and making sure we're executing every step of the way, because we really want to drive participation as high as we can. At Exceptional Risk Advisors, we also have the ability to coordinate a placement with some of the domestic carriers. So we can dual enroll, meaning we can offer enrollment for domestic carriers simultaneously with Lloyds, so that you can run an enrollment for both plans in one enrollment process. That's really unique, and it's really nice for you as the advisor and for the insureds, because if you have somebody that makes $1 million a year, they're no longer limited to buying just that $15,000 or $20,000 a month that you get through the domestic carriers. They can dual enroll and get up to $50,000 a month or $70,000 per month, which might be more compelling to them, where they're looking at the $15,000 a month saying, well, what's that going to do for me? I make $1 million plus every year. I need far more coverage than that. I'm just going to pass. So that dual enrollment really drives participation, not only for the Lloyd's piece, but also in the domestic piece. So again, if you're working with groups of high income earners, contact your RVPs at E4. They'll help coordinate that whole process for you, with your Lloyd's cover holder. So here's a quick look at a mandatory plan. We've got a number of children's hospitals on the books. They tend to provide real high compensation for their C-suites. So this was one of the largest domestic placements I've ever seen. They had $42,500 per month of domestic disability insurance, which was a legacy offer that they've carried for probably 25 years now. We came in and we just offered another $15,000 per month for 4 of those executives, on top of the $42,500. This placement took place, probably 6 years ago. And since then, we've added about 8 additional executives to their team. So again, as their company grows, as they become more successful, they're signing more executives to the C-suite under employment contracts, and we're enrolling them as they come into the company. So really nice placement. And again, something that would differentiate you in the marketplace, because most advisors don't understand how this market works or where to go for this coverage. Here's a look at a large voluntary placement. Really successful placement, definitely a unicorn for those of you working in the GSI market. Very large national law firm with more than 175 employees, earning over $800,000 annually. So the law firm, it's pretty common in these days where law firms are trying to keep up with their competing law firms' benefits to bring in the best talent they can. And so these programs have spread widely across the US for groups of high earning attorneys. In this case, we had 175 people earning north of that $800,000 figure. We came in and offered a voluntary program on top of their domestic plan, extending an offer for $50,000 a month that would pay for a 10-year period, or to age 67. And for the younger partners, they can also buy a lump sum of $3 million at the end of that period. So, premium on this policy for this whole placement was around $225,000 plus taxes and fees annually. Every year we go in and we look at increased compensation and increase the offers that we have in place. We also have the ability to offer a re-enrollment every 3 years. So if you have access to these types of groups, certainly ones you'll want to pursue. And again, just contact your RVP and they'll help coordinate with everything you need. It all starts with a census that includes not only the profile of the insureds we're looking at, but also the domestic offers that they have in place at that employer level. So Jessica, with that, I think I'll turn it over to you. Hopefully everyone found this insightful. Happy to help anyone, brainstorm through opportunities that they may have, but pleasure being with you folks today. Happy to be a part of the brew and really enjoy working with the folks at E4. So with that, I'll pass it back to you.
Sean, as we wrap up, I'd like to remind you that today's brew and our entire library are recorded and shared on the brew page of our website, www.e4.insurance. Don't forget to subscribe to our YouTube channel to keep up with all brewcasts. They are released every Wednesday. Next week, the brew will be released at 10 a.m. Central Time. Paul Zimmerman, FALU, FLMI, and VP and Chief Disability Underwriting at Ameritas Life Insurance Company will join the brew. Disability insurance underwriting can be complex, as in addition to medical history and current health and lifestyle, we also need to consider occupations and incomes. We will discuss some common issues and medical conditions that cause modifications and potential declines of an insured. Additionally, we will provide some tips to get the best possible underwriting decisions. Thanks, everyone, and we will see you next week at the brew.